Signs of a housing market crash have been showing for quite some time, and plenty of experts believe that we are bound to experience a housing crisis in the near future. We've talked about a crash in the housing market in our previous video, and today we'll be discussing an update on the situation. How will this crisis affect the economy? What influence will it have on your property investments? Watch until the end and find out the current housing market climate. Thanks for all the support you've shown our videos. Let's get right into it.
Home prices are falling at their fastest pace since the financial crisis.
Wall Street is expecting the 20-city index to jump 17% annually in July, but it's the third month in a row where year-over-year growth has slowed.
Some big numbers coming out of the housing market today, and they're not looking pretty if you're looking to buy or rent.
A catastrophic drop in property values, according to Nobel recipient Robert Shiller, is extremely likely. Historically speaking, the housing market during the pandemic could be considered as one of the largest bubbles in history. When Robert Shiller published Irrational Exuberance in 2000, he made the case that the equity market was in a bubble. Not long after that, in 2001, people all over the world watched the bursting of the dot-com bubble. After that, in the year 2004, he published a study with the subject, "Is there a bubble in the housing market?" and highlighted the skyrocketing real estate costs. As early as 2007, Shiller was warning that the housing bubble would eventually burst. And sure enough, that's exactly what happened in 2008. Now, he asserts once more that the housing market in the United States is going to experience difficulties in the near future. There has been a 42% increase in home values due to the recent housing market boom, leading Shiller to speculate that we may soon experience a global housing bubble. Home prices haven't fallen since the 2007 to 2009 recession. Right now, things look almost as bad, stated Shiller. The decline in the sale of previously owned homes and the subsequent decrease in building permits are two indicators that something is coming. It might not be disastrous, but it should be considered. Shiller concludes that a decline in housing values appears highly likely. Home values have dropped only a handful of times in history, most notably in the 1980s, 1990s, and in 2008. Typically, people will say that a bubble is present when the market value of a commodity rises above its value as established by basic criteria. Examining the connection among earnings, leases, interest rates, and housing prices is the most common method to grasp the underlying dynamics at play when it comes to the housing market. During an average year, there are 5 million home sales and between 1 and 1.5 million new houses are constructed. A rough count puts the number of homes at around 120 million, with roughly 2/3 of those being owned and the rest leased. In recent years, the annual percentage of people buying and selling has dropped to between 5% and 7%. However, keep in mind that the sale and purchase of a home by the same individual do not constitute net supply. Therefore, increased interest rates won't cause a rise in property prices. However, the data shows that prices are declining in historically expensive locations and consumer sentiment in the housing market is dropping. When the housing market was slumping during the pandemic, the Federal Reserve dropped mortgage rates to 3% to encourage home buying by making it possible for people to finance the purchase of a home with less money. After realizing its actions were having unintended repercussions like runaway inflation, the Federal Reserve allowed mortgage rates to return to their historical range of 5.5% to 6%. Interest rates are now twice the level they were a year ago, and housing prices have risen by at least 25% since before the outbreak. The cost of a mortgage has risen dramatically in recent years. A report predicting a housing bubble was released by the Dallas Fed in March of this year. The next graph corroborates the hypothesis that the existing housing market is disconnected from its underlying fundamentals. It has previously served as proof that bubbles are equivalent to genuine mortgage payments. On the other hand, the situation that we find ourselves in right now is completely unique because there has never been a genuine example of a pandemic leading to an increase in pricing. Looking at the graph here, which depicts the portion of the population that is employed in red and the percentage of the population that owns or rents a home in blue, we can observe that the two have strong association up until the year 2020. But as the government began giving out free cash during the pandemic, the correlation completely exploded. However, this situation cannot last forever. There is a good chance that the difference will reduce in the upcoming year, which will undoubtedly lead to a decrease in housing costs and rent. This second graph is very strange. The number of homes per resident in Texas has remained unchanged since 2008. The state of the economy has an impact on housing scarcity as well. When analyzing how current prices relate to underlying economic factors, Fortune utilized the model developed by Moody. The focus of their analysis was on the similarities and differences between the current housing market and that of the 2000s. Fortune magazine describes the current state of the property market in 2007. If you look at the chart, you will discover that California, Las Vegas, and certain parts of Florida were the most overpriced markets in 2007. These markets were completely destroyed in 2008. The 2010 housing market resembled a typical, stable housing market. According to Moody's Analytics, the housing market in 2020, before the pandemic, was overpriced by varying degrees in different regions. This graph depicts these disparities. The housing market quickly returned to a balanced state in 2010, not long after the worldwide financial crisis that began in 2008. Here is a chart depicting the housing market bubble of 2022 and 2020. This chart from Moody's Analytics illustrates how significantly certain regions' housing prices are either overpriced or undervalued as of the year 2022. A healthy equilibrium existed in the housing market prior to the epidemic. At that certain point in time, the housing was estimated to be worth approximately $1.2 million in 2020 and $1.6 million in 2021. However, millions of individuals shifted to low-cost places during the COVID-19 outbreak when the government began giving out free cash and remote work arrangements started to gain popularity. For example, as residents of New York and California relocated to Texas and Florida, demand outstripped supply, driving up the prices of homes that had been expected to decrease in value. In reality, the government faced a difficult position in which it needed to implement measures to stop homelessness and the housing catastrophe. There were two main causes for this. First, the eviction freeze made it possible for millions of people in the United States to avoid paying rent. The second was a halt in foreclosures, which let millions of people stop paying their mortgages and keep their properties off the market. As a result, there were fewer residences available. As if that weren't enough, the Federal Reserve launched a major QE program with the express goal of raising yearly mortgage rates to 3%. Therefore, as a result of these circumstances, the demand in the housing market skyrocketed, and as a consequence, we witness a momentarily constricted supply as well as momentarily heightened demand. A big housing bubble is expected to collapse soon as a result of market forces forcing an abandonment of the policies that led to the growth of the market. Data shows that home prices in San Jose have fallen the most precipitously by an average of 8.6%, or about $150,000. Since we started keeping records 25 years ago, we have almost never come across anything remotely similar to this. This information reveals a 1.5% drop in May, a 4.3% drop in June, and a 4.5% drop in July, all of which are quite near to being record lows. Looking back to the housing catastrophe of 2008, we can observe that in 2007, San Jose saw only a 1 to 2% monthly loss, but in the present day, the city is experiencing a historic high of roughly 4 to 5% monthly. Keep in mind that these figures are only for 1 month, so a 25% drop in home prices is still possible if the trend continues. The following chart, which displays available stock and pricing at once, is quite concerning. You can plainly see that whenever inventory rises, prices fall, and that's why they're presently shockingly low at approximately 4 to 4.5%. Even more intriguing is the fact that even though there is less supply now than there was in 2019 and 2018, prices still continue going down. Meanwhile, housing prices have fallen in Denver, which had a 55.1% share of properties respectively in the market. Examining the home stock reveals a better image of the housing collapse. Most home builders' equities have a P/E ratio of only single digits. This shows how pessimistic people are about the market. Despite warning signals of a housing catastrophe, enthusiastic consumers continue to purchase properties. This is due to the fact that the economic downturn takes between 2 and 4 years to run its course. It is also evidenced by the performance of a number of home builder ETFs that housing stocks continue to yield unfavorable returns. How do you think the next few months will pan out for the housing market? Would you still be willing to invest in properties despite their negative returns? Give us your thoughts in the comment section down below. If you enjoyed this video, kindly like and subscribe, and we'll catch you on the next one.